Hello and welcome to the Monday Futures Market Outlook for November 19th, 2012. This is Patrick Ceresna. For those of you interested in day trading, we do have a trading room open every morning. Complimentary memberships are available on the website if you visit eminisource.com. In addition, the intermarket analytics that we do throughout this morning's session, we do publish it in a timely market timing newsletter, including those ideas that would best profit from these types of trends. You could, to learn more about the newsletter, visit markettimingstrategist.com. As always, we start off with the U.S. dollar index futures, and over the last 2 months, we've been looking for U.S. dollar to strengthen off of what was an extremely oversold state. We have now reached or approached the top end of the range, which now we've defined as the 81.75 focal point, which is give or take that zone up here. You can see we are already this morning seeing a few slight rejections, nothing that would indicate a new beginning of a trend, but we do believe that that there's a possibility that U.S. dollar is going to have some substantial overhead resistance here, and that the upside that we were looking for the U.S. dollar over the last couple months at this point is very neutral, if not even not enough potential to make it worthwhile looking for more out of the trade. At this stage, while we don't want to become outright bearish to U.S. dollar, we do think that this could be where overhead resistance comes, and if it does reverse, it certainly will act as a stimulus for putting in a stock market bottom. Next year, when we take a look at the euro, whether the U.S. dollar has a substantial move higher still or not will be very much dependent on whether or not the euro here hits a bottom. We're coming into a crucial point. Not only was this 126.50 give or take area where the lows came in back in January, but also some short-term highs came in there in June. This is a Fibonacci retracement level after that short-term top we've seen up along the 31.50 area. If the euro manages to muster a short-term bottom here, not only could the euro muster up a rally back up to the 131.50 area, but we could see short-term strength over the next 2, 3, 4 months that could even see 135 on the upside. While we're not very optimistic about wanting to trade this, it is a possibility, and that kind of a rally certainly would stimulate some of the different markets that we're about to analyze. And so a lot of what is going to play out is whether that U.S. dollar has hit a short-term top or whether the euro has hit a short-term bottom. These will be key themes of our bigger picture outlook over the next couple months. Next year, I want to take a look at the 30-year Treasury bond, and we've seen a substantial rally in the last month on the upside, but we're now approaching some key overhead resistance levels. And while we certainly don't want to suggest that it's a certainty that there's going to be a retracement off of this, but if there was, if that overhead resistance here acted like the top end of the range and it sold off to the bottom end of the range, that would act as fuel for allowing commodities and the stock market to move higher. While it's very early to even imply anything, because if suddenly we find Treasury bonds breaking to all-time new highs, the trend can just continue. And so we are just going to be looking at this very neutrally and looking to see whether or not these Treasury bonds fail at this overhead resistance. Next year, I want to take a look at copper, and whether copper here rallies or not is again very much dependent on all of those inner markets we were talking about on the currency and bond front. Really, at this stage, if a short-term low is in on copper here, and this entire pullback was just a very deep retracement, then there could actually be buy signals in copper coming in here right off this very level. And while I don't, again, one-day reversal back up does not make a new trend, this would be a very logical place from which a new rally could begin, and therefore we give it that much more relevance to see whether or not the price action follows through. So watch it here. This could be the buying opportunity on copper. Similarly to copper, when we take a look at crude oil, we've also had a very deep pullback, which we now have adjusted the focal point to this $85 level. We've now seen about a month of consolidation at there, and every time oil's tried to sell, the buyers would support the price down at this level. We were concerned that there would be the room for crude oil to weaken all the way back down to the 80 and 79 levels down below, but there is a possibility that the lows of crude oil are in. And when, just like copper, we don't want to be too ambitious to call a bottom just because we've seen a couple up days. This is a very logical place from which crude oil to make a bottom, so that it's very relevant if we can see momentum break here on the upside. If we see price action particularly strengthen to $90 or higher and hold up there without immediately reversing within a day, that would be very constructive in starting to build a case that crude oil has bottomed and reversed. Next year, I want to take a look at gold, and when we take a look, we were suggesting that the bottoms of gold would come in around the 1650 to 1700 area. While we have had about a week of pullbacks to retest that zone, overall gold has done a very good job holding in. We were suggesting that as long as oil selling is contained, above 1700, that it would be very constructive. But even if we still yet seen one more retest of that low, or even a temporary lower low that immediately reverse back up, we would still be suggesting that this is a level to accumulate gold, and we are buyers of gold here. Finally, I want to take a look at the S&P 500, and in this market here, we've been looking for where the lows would come in, and we marked off in that blue box that 1340 to 1380 area, which is the home of some of the retracement zones from which we were looking to see the S&P hold during one of these moves. At this juncture, that we've now had two very positive reversal candles coming in here off of a test of 1340. And while we felt that there was room even down to 1330 or 1320 on the downside, it is this is the level where if we saw the stock market bottom, we could have a substantial and material Christmas rally come off this level. We are very interested in the risk-reward proposition of owning the stock market at this level, and while we certainly will not rule out the possibility that there could be one more round of selling, we do believe this is the 8th or 9th inning of a 9-inning correction, and that being a buyer at these levels makes a lot of sense. Just to review our key intermarket observations, we don't want to rush off to make the risk-reward proposition of the U.S. dollar poor, but we certainly are not ambitious to own it at this point. When we look at commodities, we've now actually changed from average to good, so this is our increase. We do believe that while there's always a possibility that commodities can still do a little bit more selling, at this point the correction we've seen over the last 2-3 months in these commodities makes many of them cheap. And we think that owning them here makes sense because the bonds are approaching those previous highs. We think that the risk-reward proposition is poor, and we may reevaluate things if a whole new up leg in the bond market begins. But at this juncture, we're going to stick with our recognizing the overhead resistance that lies right up here. We've now changed global stocks to good as well as U.S. stocks. We do believe at this point that owning stocks or equities after the last month or two of correcting makes a lot of sense, and we think that this is a level from which, even though there's always risk, the potential returns that we have there for us, if for the risk we have to take, makes a lot of sense, and we are buyers of the market here. That was your Monday Futures Market Outlook. Thank you for joining me.